So in this presentation, I'd like to set the rise of the corporation in Britain in the broader context of Britain's economic history, particularly industrialization and in the political economy around the evolution of the British capitalist system through the 19th and the 20th centuries. So the first thing I'd like to do is just simply point out that there was a very gradual but significant process of economic development in Britain and in several other places in Europe that brought about quite substantial rises in relative real wages long before the industrialization process was fully underway. And we can see from this particular graph here that by the late 16th century, key trading and finance centers had brought about a significant rise in this measure here of labourers' wages, and this is showing from 1409 to 1799, and the red line towards the top there is Britain, and Antwerp, a major trading centre in contemporary Belgium, is another clear instance here. So that actually what we see is as capital accumulates, particularly in urban centres, and we get more specialised trade and increasing sophistication of economic organisation, then we see that there are rising real wages. Now this is likely to draw people, of course, from out of traditional sectors such as agriculture, and in turn lead to, if not necessarily labour shortages, at least a diminished supply of labour relative to the demand. And that in turn should have raised wages in the rural sectors of the economy as well. The bottom line there is in purple is Strasbourg. So we see that the very significant town bordering France and Germany and contemporary France, although it's central to Europe, was maybe less central to trading networks at the time, and we could explore the reasons for each of those particular trajectories. That's not our concern here. Sometimes it's a function of political instability, for example, and a whole range of things going on. But our key takeaway here is that before we see industrialization, the Industrial Revolution that we're all familiar with, we're already seeing gains from trade, specialization, expansion of the organizational capabilities to fund trade. We saw a similar phenomenon when we discussed the Hanseatic League, for example, which has an even longer historical trajectory than we've just noticed there, with a similar kind of effect for the trading centres. The Industrial Revolution accelerates the pace of incomes, income growth in real terms. This is GDP per capita in 1960 US terms. This was done by a very influential economic historian after World War II, and hence it's dated to 1960. And this is part of a broader discussion of a great divergence. And most strikingly, we see Britain and subsequently France and Germany, but most strikingly Britain having a significant increase in GDP per capita with the Industrial Revolution. And in places where industrialization scarcely happened, such as in Russia or in large parts of Italy, you don't get the similar kind of growth. So where was industrialization happening in the British context? Well, as we're in the midst of some really quite profound discussions about energy and green energy and whatnot, and decarbonising our economy, it's an timely reminder to note, of course, that to a significant degree, industry followed the power source, and the primary power source was coal. Fossil fuels, quite literally, fossilized trees. That's what coal is, of course. And we can see here the brown spots on the map appropriately, kind of brown, bit dirty, although we should make it almost black. These were key centres, South Wales, for example, around the Clyde, significant river system there in Scotland, and a number of other locations, the Midlands and whatnot. And so the significant development of coal helps to fuel industrialization powered through particularly the innovation of the steam engine, and the steam engine becomes a power plant that can be used to drive a whole range of equipment, of machinery, of mills, effectively by having belts that transfer the energy to the drive wheel, and you can do so many different things with it, including even running sawmills. You can put it on, as I've discussed in a previous video, in the context of making railways. You can actually mount it on wheels and drive literally steamrollers, as we still reference them today. And you can put them, of course, as a powertrain onto wheels and run them on rails and have railways. And all of those things come together simultaneously. So what we see here with British growth is a very substantial rise in industrial production over time. You can look more carefully at these slides themselves, but I also want to emphasize that there was a growth in population as well. So you actually have a growing population, very substantially growing population, but you also have an increase in GDP per capita, as we saw in the earlier slide there. And if we look at this top graph here, quite strikingly, population in England, we see that between 1800 and 1851, the British population actually doubles. And then again, by 1901, it nearly doubles again, not quite doubling again. Generally, as people become more urban bound and more educated, they, as we've seen everywhere in the 20th century and into the 21st century, they tend to be more self-governing of their fertility, and as a consequence, the rate of population growth slows down a little bit. Of course, what we're seeing in the early 21st century is, of course, very significant flatlining of population and significant demographic shrinkage in some places. So another part of the development story, the railway story, of course, really tangible in terms of linking up the nation as a whole and creating a national economy rather than a lot of regional or localized economies, which happen to be within national boundaries. The railways, and we can see particularly the dramatic acceleration in the spread of the railways in the 1860s into the 1870s, and then a leveling off of growth as you get to the end of the 19th century. So I want to step back and set a broader context of political economy in talking about Britain, because we see substantial differences from the United States, and yet there are also many familiar elements, as we've discussed in the US context. Of course, the US initially established as British colonies, the legal system, upon which later on corporations law is more fully developed, first of all in the United States and then brought back to the UK. So we have these common institutional legacies, and yet we find actually that there's significant divergence in the political economy in the 20th century in particular, and this does have some impacts on the trajectory of both economies. We can identify several distinctive periods. Historically, Britain was one of the most laissez-faire, literally to make free or leave free, business environments in the world. There was a very strong notion that the state should not overly tax private enterprise, corporate endeavor, and particularly with the critical decisions to actually repeal some what we call the Corn Laws, which put tariffs on imported grains from outside Britain. This opened up Britain to the importation of large volumes of foodstuffs, particularly grains, of course, into from the New World, particularly the United States, and with increasingly at scale for all the reasons we've seen in the context of the increasing integration of the United States into transatlantic trading networks and the scaling up of both agricultural and manufacturing production, and particularly again by the railways driving that, and the ability to actually get agricultural product at great volume to ports and then to ship them across to Europe, initially primarily to the United States, but to other markets very significantly as well in Europe. So one of the consequences of this is that agrarian privilege, agrarian interests associated historically with the aristocracy tend to be weakened economically, to some degree politically, and rising manufacturing interests, urban economic interests, and financial interests in particular that are involved in transferring of capital to the New World as well, to take advantage of business opportunities there. All of these can tend to triumph through the political process over established historical agrarian interests. So in short, industrial interests are favoured, and the Industrial Revolution proceeds apace, in no small part because of the availability of cheap food from the New World and a lot of trading endeavours that take advantage of this, help to accumulate more capital, and we see this very much contributes to London's dominance as a source of capital investment. So we see strong competition in product markets, very few barriers to entry by either domestic or foreign capital. And we see that companies that develop in the United States that are very strong in manufacturing move to Britain. Some of the earliest multinational endeavours are American companies taking advantage of the relative openness of the British market, and the other way around. So the City of London, without doubt, becomes the world's largest financial centre, and is so for several hundred years. This reflected the domestic capital accumulation through the Industrial Revolution, also British imperial influence, which helped to create new investment opportunities. But it would be wrong to think that the rise of the City of London depended upon Britain forcibly turning the world into colonies. We see that British capital flowed into many places where Britain was not the colonial power. We see, for example, the development of the Brazilian coffee industry was to a significant degree, actually financed by British capital. And much of the export of the coffee from Brazil actually went to the urbanizing, particularly East Coast United States market. We have the image of England as a nation of tea drinkers, but it didn't stop the British financing the growth of the coffee industry, for example. So we see that there was lots of financing of frontier economic developments, both within and beyond the British Empire, in a wide array of areas, whether it's nascent infrastructure building, such as, again, railways, or providing just a whole range of materials. For example, in my country, in Australia, widespread land clearing and fencing for the pastoral industry was very significant. So really basic things like fencing wire produced en masse, building materials that would be forged building materials, for example, that would be shipped halfway around the world to underpin the growing urban centres that were drawing a lot of prosperity from the settlement of the hinterland in places like where I grew up in Queensland, for example. So the City of London gained and retained significant political influence on the back of its economic influence. And we see this later on with the Thatcher government from 1979, that the Thatcher government was very much supportive of what we refer to as strong pound policies, and this had an impact on British exporters who had to compete against cheaper imports from places like Japan, for example. And this is an ongoing debate in the British context about the City of London and whether the British policies have been too London-centred, finance-centred at the expense of regional economies. So we see significant deindustrialization of parts of Britain after World War II, particularly in the 1970s and the 1980s, and quite substantial divides in identity within regions, between regions and London, for instance. Now, one of the interesting things we see in Britain, in contrast to the United States, is that founding families of enterprises continue to play an ongoing role in business. And there are various reasons for this, but it seems a little bit contrary to our understanding of how the Anglo-American capitalism worked. That, of course, you had founders for businesses, but they scaled up, they became public companies, they gained diverse shareholders, and the scale of the business was so large that effectively the ownership of a controlling stake was improbable. Yet, for various reasons, we see the founding families tended to play more of a role. Companies were generally floated on the stock market, but founding families tended to keep a stake in the business, partly because of complexities of tax rules and whatnot. Also, a difference is just simply the scale of the economy. The American economy was a much larger economy. Enterprises became much larger, the greater capital intensity, and there was a natural dilution of the original shareholder stakes of the founding families, for example. But also just simply the tax regime and whatnot was friendlier to founding families selling down their own stakes and diversifying their own wealth through other investments. Clearly, the UK, though, had some of the earliest and most sophisticated stock markets, and was also quick to develop strong legal protections for minority shareholders. That is not surprising given the sheer influence of financial interests, of whether it's aristocrats who had a certain degree of savvy, had put their money into some early company investments and had not bankrupted themselves and were keeping their estates and whatnot, and wanted certain legal protections as minority investors, as passive investors, and of course many other manufacturing and trading entrepreneurs whose wealth was then put into diversified assets. All of these investing interests demanded a certain protection in law from some of the rascals, the scoundrels, the scammers, who might be quick to float companies and take advantage of gullible investors who had become shareholders. So we see there was not the same degree of a separation of ownership and control as happened in the US in a significant number of cases. So we do see that the founding families often remain influential block holders, owners of large blocks of shares, really until the 1980s, strikingly. And this has been discussed as often a negative. It was seen that the founding families didn't sell down, but the founding families didn't necessarily bring a great degree of entrepreneurial flair. Remember, one of the powerful arguments in favor of the separation of ownership and control is it allows specialization. Specialization in terms of providing capital. You don't have to be good at running a business. You just simply invest in the share market, perhaps through a passive portfolio. And then we have a professional managerial class who have either very good on-the-job training, and this is something we'll look at when we talk about the Japanese context, or they have had very good training through a university system. For example, the US led the world in terms of the development of business schools. The MBA is a very distinctive American innovation, the Master of Business Administration, that a whole cast of professional managers were trained by increasingly a large-scale education system which was geared to those purposes. The UK was much slower to develop specialist managerial education. It had quite specialist education in some forms. Technical education, engineering, for example, was quite strong, although overall rates of participation in higher education very much lagged, even today lag, the United States. Indeed, Japan was certainly ahead of the United States in terms of ahead of the UK in terms of boosting participation in higher education. Another critical perspective in relation to the UK was that industrialists were much too quick to try and turn themselves into quasi or pseudo old money, that they wanted the trappings of old money and downplay their entrepreneurial heritage. Of course, one of the most common self-criticisms in Britain, particularly in the English context, is that the class system continues to persist. Although so many people who see themselves as old aristocrats and whatnot, many of their families really only made good, got themselves great landed estates and titles and whatnot with the English Civil War a few hundred years earlier, and they were on the right side. And we do see that many people, when they've made their money in trade, in commerce, in manufacturing, for example, wanted to set themselves up in a similar kind of fashion, to buy a nice old pile of stones in the form of a castle or a grand estate in the countryside or whatever, and to take on the trappings of old money. Another really striking thing in a British context is the rise of organised labour. We see that the trade union movement was very active. There was a lot of political organisation, effectively, when strikes were frustrated sometimes with state authority, particularly with the high concentration of urban manufacturing workers. The rise of the trade union movement in turn led to a broader push to create the Labour Party, the British Labour Party, and so we see the Labour Party is the political arm of the trade union movement in a fundamental sense. Now, there's a wide array of ideology there, from the left to the very, very pragmatic side of the Labour movement. And often the Labour Party and unions themselves have been divided on strong ideological lines internally. We see this is the case also in continental Europe. We talk about this, that actually there are even peak organisations that are rival ones, one more communist-dominated versus more moderate ones as well. We see this is the case in France, in Italy, and elsewhere. Now, we do see with the rise of Labour and the very significantly a British Labour Prime Minister at World War I and after World War I, Ramsay MacDonald, for example, Labour is kind of brought into the fold and becomes a significant part of mainstream governing culture and political culture. So we see in the 1920s, after the mass mobilisation, the tragedy of World War I, an enormous loss of life, a strong sense that anyone, regardless of their class background, they had put their life on the line, and large numbers of people, of course, had enormous numbers of working class men had died in World War I. Therefore, labour interests should be equally represented in the political system, and this led gradually towards policies to expand a welfare state, for example. This is particularly so after World War II, after 1945. Very significantly, Winston Churchill, the great British Prime Minister, the hero of World War II, even before the end of World War II, he actually, just after the defeat of Germany, but before the defeat of Japan, Winston Churchill actually loses a general election. And he had been offered the Potsdam Peace Conference, meeting Stalin, and he had to return back home for the election, which he promptly lost, and a new Labour Prime Minister came to power in 1945, Clement Attlee. And we see the Labour government there very much was arguing that it had been a national struggle against Nazism, and therefore everyone in the nation should have a decent stake in the post-war future. And the economy was in not a particularly good state. Britain had pretty much exhausted itself with its mobilisation efforts. Indeed, actually, a lot of its infrastructure became quite run down because so much of its manufacturing capability had been directed to the war effort. So we see this left-wing turn is significant, that a lot of assets, things like railways that had been privately owned, were nationalised. They were taken over by the state. One of the reasons why this was even politically possible was that actually many of these assets, as I was just hinting at, were in a rather parlous state. that they needed a capital injection, and many private owners didn't have that capacity to do that, so nationalisation became more acceptable. One of the problems is with both a Labor government and then the state owning some of these assets, unions became quite powerful in terms of making demands upon management for improved working conditions and whatnot. So this is rushing through the complex history of post-war Britain, but we do see that there are pockets of real industrial strength for Britain, but a lot of challenges. The rise of the common market, later to become the EU, and whether Britain is to join that or not, and it eventually does. One of the factors that impacted on Britain's economic situation was actually the rise of Japan as a competitor. So Japanese manufacturers in a range of fields such as the car industry, motorbikes, for example, from the late 1950s into the 1960s, electronics, a whole range of consumer products. We see that British industry faced some competitive pressures, and it's we can exaggerate the extent to which post-war Britain fell into stagnation. There are certain periods. There was a recession, for example, in the late 1970s, after the second oil shock and whatnot, which helped to contribute to the election of Margaret Thatcher, leading the Conservative Party. But for the most part, it is safe to say that Britain found its manufacturing sectors under greater competitive challenge, and finance was a significant part of Britain's continuing competitive advantage. Strong pound, as I said earlier, further compounded the competitiveness problems of the manufacturing sector. So what we see with Margaret Thatcher is a very significant turn towards more free market policies, and we see substantial privatizations, although we can argue that the way privatizations happened was that they were designed to serve certain political constituencies, and they may not have been the best way to do privatizations. We do see further market liberalizations, very strong influence of city financial interests, reforms or cutbacks or brutal cutbacks, depending on your ideological perspective, to the welfare system, changes to the tax system. One of the consequences of changing of tax rates and things like capital gains tax and the abolition of death duties and whatnot, and gift taxes, is that small shareholders and institutional investors become more important, and it is more attractive for those who had inherited stakes in businesses, who held them as block shareholders, to sell down their stakes, diversify their assets. So we see that shareholder capitalism becomes reinvigorated through a range of reforms. It happens with Margaret Thatcher. This leads to a fuller separation of ownership and control, and further professionalisation of management and governance. Excuse me. I would like to edit this out, but I won't, because it's lots of complications. As soon as I start to edit, I have to do a full rendering of the video, and we lose further resolution and all the rest of it. So think of it as a pre-recorded Zoom at a better quality than we normally get with Zoom. Okay, so bear with me if this is not very articulate at times. Okay, so I'd like to speak very briefly to, and let me adjust this, because the slides are a little bit chopped off. I'd like to there we go, it's a little better. Okay. Okay. So I'd like to speak briefly to the invigorating of UK corporate governance, because one of the interesting things is, although Britain was a little bit slower in terms of the separation of ownership and control compared to the United States, the legal foundations of Britain was for rigorous corporate governance were always very, very strong. And remember that London has always been, still is, one of the, still the preferred legal jurisdiction for writing international contracts in relation to trade. So still Britain has a profound competitive advantage in terms of providing the legal foundations for international business. And even American companies that are contracting, that are operating globally, it's not unusual that they actually would identify the jurisdiction for any legal issues that arise around a contract to actually be London. And the corporations law and practice in the United States still very much judgments very much accept British precedents as well. So in the case of corporate governance, what we see is that the UK corporate governance codes, because there's a lot of debate about making corporate governance more rigorous, again reflecting financial interests, their stake in this, and the competitiveness of London as a financial hub. All of these lead to pressures for the UK to have world-class corporate governance practices. So we see several reports. The Cadbury report, very famously, Adrian Cadbury, and yes, that is related to Cadbury's chocolates. Adrian Cadbury is of the esteemed family that obviously were very significant pioneers in the sweets industry. Okay, so Adrian Cadbury symbolises the UK change, typical example of a founding family member, but he champions very good governance. And so they build on a long tradition of legal protection for minority shareholders, emphasise the responsibility of management is ultimately to the owners of the firm, and this complements the historical freedom of the British market for corporate control. So, as a generalization, we can say that across the Anglo world, but with the United States and then very much formalized, articulated in law and corporate governance codes, very strong shareholder value norms. Anglo-American countries in general, distinguished by this idea, and as I say here, longest and most strongly established in the United States. And this has been encapsulated in the very controversial words of Milton Friedman, liberal economist in Chicago, who has often been just described as a ultra-extreme free marketeer, extreme right, and all the rest of it. That loses some of the nuance in terms of making sense of Milton Friedman. But very famously, he said, the social responsibility of business is to increase its profits. Now, for many people, that sounds like something you should go to hell and burn forever for. But Milton Friedman was making a really fundamental point, that there is a kind of division of responsibility here. That, and this goes back to the shareholder norm notion that we talked about in terms of understanding concepts of the firm around in our presentation on agency. That he was saying that there are different levels of governance. Private governance, there's the corporate governance level, and then there is the public governance level. And it is the responsibility of public officials, governments of the day, through the state, to specify desirable social outcomes, what's good practice, what's bad practice, to set the legal context, the policy context in which businesses go about what they do. And so he argued that the social responsibility of business is to increase its profits, and if government wants to affect welfare transfers, if it wants to help some members of the community at the expense of others, that should be done, for example, through the tax system, and it should be completely transparent. And his argument is a not insignificant one. It said that effectively the managers of an enterprise do need a decision rule. We saw this in a previous presentation set of slides, that ultimately when there's a clash of interests, and there's quite routinely a clash of interests between different classes of stakeholders in a firm, we need a decision rule. And it's so that Milton Friedman's argument is that, well, you should increase profits, act in the interests of shareholders within the constraints set by public governance. Of course, many of those qualifications were lost, and it was seen as just a outright justification for let it rip, let corporations do what they want, free from regulation. That would be a chronic misrepresentation of the more nuanced position of Milton Friedman. Although that said, he was also quite a critic of a lot of what he saw as quite clumsy regulation of markets. And this is something we will engage with subsequently when we talk in particular examples, because very often actually well-intentioned regulations can be gamed, can create perverse incentives, as we've already touched on. And so his general predilection is to say, show us the market failure. Where is the market failing to deliver a desirable social good here? If you can demonstrate that there is a market failure, there's a case for some kind of government intervention. But in the first instance, what governments should be doing is they should be providing, obviously, in infrastructure that the private sector would naturally provide, and setting rules, policies based on some clear ethical or desirable social outcomes, articulating the logic of that, justifying it, winning popular support for that. And then when those views are embodied in law and regulation, businesses act within that context to maximize profits. Now, arguably one of the flaws with Milton Friedman's argument is that precisely because economists take so seriously informational shortage and whatnot, that in reality there are profound informational asymmetries between the state, of course, and our complex society, that so much of our day-to-day complexity, technical complexity, organizational complexity, is actually centered in companies. And as a consequence, this inherent information asymmetry means that if the state was actually to try and have the capacity to set very detailed restrictions, guidelines on what firms should be doing, then it would be extraordinarily intrusive and quite inefficient. So in some broad sense, to throw it back to companies to take responsibility, to act according to certain principles, knowing that the companies actually have a huge informational advantage, they're closer to the potential problem or the opportunity in the first place, seems to actually be very consistent with Friedman's view. This is where we can make a bit of a plug for the advantages of the common law tradition, that some of those common law general principles that are not written into black letter law, but the law of torts, due diligence, a whole range of aspects of the English common law, naturally give rise to certain legal obligations to be responsible. So certain principles have evolved through the English common law tradition, and that means that actually the state itself doesn't need to specify in superfine detail exactly what corporate actors should be doing, that there are some general principles that should be upheld by companies. And so there's always the scope that someone will bring legal action against a company, not because they've breached a very clear law, but because there's a broader legal principle there which they have breached, and the very specific details will be examined in a case, and then of course a new precedent would be established. By the way, what often happens then is that subsequently the rest of business stakeholders, similarly facing similar operational circumstances, then ask that the state, or demand that the state actually make clear the guidelines, and it's often then written into black letter law. But the broader point we have to look at is the political economy one. We see this very significant turn in the late 1970s in Britain with Margaret Thatcher, mirrored to a significant degree by the Reagan administration, which comes to power in January 1981 towards removing some of the constraints on business, cutting taxes and whatnot, more free market orientation, but also a smaller state orientation. We'll see when we draw a contrast with how the similar kind of ideas were implemented, though, in Australia and New Zealand, and often referred to as economic rationalism, that one can have pro-market policies without having some of the Thatcherite social agenda, because Margaret Thatcher and the Conservatives were quite hostile to a welfare system, for example. They're very antithetical to, in opposition to a Scandinavian model, for example, which also does embrace a significant degree of flexibility and openness, but also maintains a very strong social welfare perspective. We see the Labour governments in Australia and New Zealand, I'll talk about this in another presentation subsequently, embrace some of the reforms that are often associated with Thatcherism, but they do so at the same time of trying to enhance a more targeted, a more efficient, a leaner, but still supporting social welfare system. Now, a very important part of this, which is often forgotten, is that this turn towards free market, smaller state ideology in the late 1970s and the 1980s is economic rationalism. The quid pro quo of this is that, yes, managers should be very much valuing shareholders. Managers themselves should be disciplined by a very vibrant market for corporate control. If managers mismanage the company and the share price falls, then you would expect a takeover bid, whether it's from private equity or some other listed company who would see that it's being run inefficiently, and the managers could expect to lose their jobs, that there would be rationalization, so that's part of it. Also, that companies shouldn't go running to the state asking for protection from their foreign competitors. And certainly there were plenty of attempts to do this at the height of fears about Japanese competition, for example, when Britain went into the European Union. One of the things that actually did drive the expansion of the EU and integration was a sense that the EU was under some kind of competitive threat, particularly from Japan. These days that's less of a concern. And so some people supported Britain's involvement in the EU. Of course, then there's all these other issues of the regulatory agendas in the EU and standardization, regulation. So there's always been a mixed feeling in the UK. And of course, we see ultimately with Brexit now, the UK is back out of the European Union. But those norms that you don't have restrictions on foreign investment unless it's a very sensitive sector, and then there's very few restrictions in the UK. You don't have tariff protection. You accept international market prices, and that firms have to respond to make themselves competitive. They don't run to the state to ask for assistance. So this is very much a package. It's not just that the state downsizes and leaves things to business, but then business runs back and says, protect us. Okay. No, the notion of economic rationalism in some sense ultimately says that everyone must be subjected to the dictates and disciplines of the market. And unless there is some very powerful persuasive argument that there is some kind of deep market distortion or market failure, there isn't a strong pretext for state intervention in the economy. We'll see how that plays out in other parts of the greater Anglo world, and particularly in the Australian and the New Zealand context, but we'll also make a few references to Canada and beyond. So thank you for your attention.